morning, everybody. It's Tuesday, March 26th, and this is the AgYield War Room. I'm Dan Dempsey, and I'll be moderating today's session. As always, if you've got any questions or comments, please feel free to drop us a line in the chat area. I'll be sure to get to it during the show. Quickly here, overnight markets had May corn down a quarter at 437.5. May soybeans were down 6 3/4, 1202.5, and May Chicago wheat was down 2 at 553. Not much on the way of overnight news or anything really big happening, in the grain complexes. There was a large accident on the Francis Scott Key Bridge in Baltimore this morning, or I should say early this morning. Ninth largest port out of Baltimore that, was pretty tragic. Took down the ship. I think it was a Malaysian ship, hit the base of the bridge, took the bridge down. I think there's some people still missing, but so our thoughts and prayers are with those folks, and hope that they figure all that situation out. Certainly scary to watch on the news here this morning. Outside of that, guys, in the grain markets, we were talking this morning, we're starting to see a little uptick in volatility, kind of allowing for some different types of strategies to be put together, which is good coming into the report. We've talked about that a number of times, that for those that, need protection or would like additional protection heading into what could potentially be a pretty significant market mover. That's historically been the case. So Ben, we'll shoot it over to you to start this morning. I know you were looking at some call slopes and things of that nature. Maybe start us off and we'll move it around the room here this morning.
Yeah, I think, one of the things that we talked about beforehand is that we're seeing call slopes stand up pretty hard in corn. This is typically kind of gives you a little bit better risk return on different types of hedges. It's worth taking a look at. So, if you're interested in those kinds of trades, by all means, talk to your advisor. It has those types of trades have a unique risk prop, and you have to make sure that you understand it. But when you have those higher slopes, it means that people are willing to pay more for calls, and that you can typically use that to your advantage as a producer. But again, it comes with trade-offs that you should be aware of. It typically increases the value or the window for trades like min-maxes, accumulators, and things like that. So talk to your advisor before you jump into any of those, but something worth looking at. I think there's we've had a really nice, we talked about this kind of ad nauseum for the last 10 days, but we've had a really nice bounce. I think that trying to decipher here if this is something that is sustainable on a seasonal aspect, or it's just a typical first notice day bounce and people are waiting to see the report numbers, and we resume a downtrend. That's just, you don't know how that works out, but it has definitely improved some of the hedging tools that are available on a bounce, and seeing the higher call slopes in corn. Kind of the opposite in soybeans. They're a little flat. There's been some very heavy call selling in beans on rallies, some really large quantities, and that is one of the factors that drive those slopes are participation. And when we got corn, the people looking at the lower prices, the seasonality, I think there was some appeal there. And we also talked about managed money's willingness to part with a really profitable trade. I would lean towards the fact that maybe they've been buying calls to protect their position, to get them through kind of a seasonal tendency to rise here. It's a much cheaper way for them to protect a really profitable position. And beans have just seen outright heavy call selling. So I do think it's an important facet of the trade, especially when we go back to 5 weeks ago, when we were pretty adamant about not getting involved in certain types of transactions because the risk prop had gotten flattened and it didn't look good, both from a price, from volatility, and from a skew perspective. And that's kind of worked its way back in corn. And it's a conversation worth having with your advisor.
That's good stuff, Ben. I'll ask the question. I think that's going to be on a lot of the farmers' minds, and we'll throw it over to Dustin or anybody in the room here. But Ben, you reference, the call side of the corn complex getting interesting in terms of slopes, and the beans not so much. Is that a foreshadowing for potentially where they're lined up ahead of this report?
You never know what people's motivations are. Kind of what's behind curtain number 3. And I think that it just becomes, from a trader's perspective, you look at some of these things and you go, okay, this is a reasonable place for me to place units, right? For me to get some exposure that I would like to have at a reduced rate. And it's a very clean risk prop, especially for the people who are buying those calls. We may see a combination here of some managed money trying to cover some really profitable corn shorts. Maybe some producers doing a little bit of hedging and getting into some call protection. I think on the bean side, it's been pretty amazing how aggressively they've sold calls on rallies. You actually see kind of the counter of what you would normally see. Vol's actually gotten softer on rallies and gets firm on breaks. So, what their motivation is for doing it goes back. I get people asking me all the time, well, do you think you'll ever be replaced by AI? And I just listen to that. And being a guy who was displaced.
There's no replacing you.
Well, because of electronic markets, I think that the collective chaos of so many participants, the massive volume, I think that it's like anything else. You might be right twice, but you could be wrong the third time and be a lot wronger than you were the first time. So again, markets aren't really always, from our perspective, it's not always about trying to figure out where the next move is. It's about trying to extract margin. And it's giving some better opportunities to do that the way the options are pricing. So.
Oh, very good. Dustin, I saw another, corn export inspections yesterday were up 78% from the same week a year ago. They were just slightly lower than the previous week, but still, it's nice to see that folks are in for corn, and we continue to see that that week over week, and we'll have export sales certainly on Thursday and see if we continue that pace. But thoughts there?
Yeah, I think that's one shining light on the demand side, exports to Mexico, especially. We are expecting a fairly sizable carryout. I think WASD is still, just shy of 2.1, just over that. And so you're still looking at a fairly high stocks to use carryout for corn in the end. And one of the things we've noted on this show a lot over the last couple of months was just, you look at that commitment of traders report and you see the commercials where, very little short, somewhat net long compared to managed money, which was holding the short position for corn for a while. That's just a sign that the buyers have already come for the corn and the sellers have not yet sold enough of it. And I think that could be just another sign of the basis only problem that we've had. So in the end, if we are left with a 2-2 carry out, regardless of favorable exports, at some point there's still going to be corn that wish that was sold going into the end of the summer if there's no problem in South America's safrinha corn. And that's where I think you still see some spread widening occur here. So it's been a long time coming that we've had expanded storage rates at the CME. December 2019 is when that contract change happened. And it wasn't until this year where we've really had a carry out that we can test what that really means to the market. What an approximate 8 cents a month CME warehouse receipt expense cost does versus what was previously a 5 cent per month cost. So we're still, I think that the recency bias of where spreads have gone in the past is probably why we had some problems with market fairly valuing spreads going into, November, end of November. We got the December first notice day. We saw the same thing with the March contract. Now, once again, we're seeing some widening again in like July D's, for example, and despite the rally. So long story short, I think that despite favorable exports, you're still getting cues from the market that the market is satisfied with demand through the end of this crop year, the 23 season. There's going to be a carryout, right? A sizable one. What is weather going to be for the 24 season? And, we know that we're at least going to have a 2 billion bushel carry in, 2.1. I think it could be 2.2, 2.3 before it's all said and done. But, we have that to figure out here on this Thursday report, what our first glimpse of actual surveyed acres are expected to be. And then we'll have to see, obviously, what the season does as well. We have definitely a buildup of carry in to give us a little bit more comfort. So any sort of summer weather rally that we might have had last couple of years, that was coming from, lower stocks carry in, following all those years that we haven't really been able to test these spread rates. Now we've got a pretty good sized buffer built in. We don't probably need as many corn and bean acres as we have in the pipeline right now. Thursday's report will show that what we're projecting is it going to be 93, is going to be 91 for corn. But I think it's important to know that we just have a little bit better buffer overall, and so the rallies may be a bit more subdued, and that's giving us lower out of the money call vol than we normally would expect. One thing I think would be the best thing for us is if energy prices continue to rise, right? If we start to see crude oil, starting to push into the 90s, maybe $100 on some of this geopolitical tension, that's probably our best chance for getting really good selling opportunities as we have right now. Or dryness expands in the West going into June. That'd be the other one. So
those good points. I did notice yesterday winter wheat ratings, good to excellent category. Kansas dropped a couple of percentage points down to 53%. One thing I noticed though, Oklahoma was up 9% in their good to excellent categories yesterday, and Texas was up 5%. There in a couple of states, obviously Kansas being a big one, to drop a couple of percentage points. Ben, what have you we've obviously seen a little bit of a pop in wheat the last 10 to 12 days or so. What's your thoughts there just in the wheat complex real quick? You're muted there, Ben.
Sorry about that. I think some people probably a little bit uncomfortably short as there's been, an elevation of hostilities in the Black Sea, Russian quality concerns, world values have firmed up a little bit. There's big long-term trend line that comes down across 580 in wheat. We made it up to 566 yesterday, and it fell all over itself. It was a pretty ugly decline all the way down to 449 in the day session. Wheat is a market that now, we definitely come out of dormancy kind of early here with a really mild late winter. And I think that, people are probably looking at historically, we've had some pretty wild Aprils in wheat. If we were to see a cold snap, and I think that we've come far enough along, the crop looks great, that maybe it's taking the edge off wanting to be really short for the next, call it, 6 to 8 weeks until we see how it's going. But yeah, I think it's a place where it can be a little bit uncomfortable to be short wheat for the big position that's in there.
Appreciate that. Rylan, we got a couple minutes coming into the open here. We're going to have hog inventories out on Thursday at 2:00 Central. A couple of thoughts on what we're looking at pre-report there, and I guess livestock in general.
Yeah, I haven't seen the report estimates yet, so I'll release those once they kind of fall on my desk here. But we bounced a little bit in hogs yesterday. I think just in general, everybody's just kind of following seasonal momentum right now. I mean, we're coming into that time frame where you're really seeing the ramp up before grilling season. So, we're at a really high price, just at least on the chart. So I think we're trying to see a little bit of a bounce. Cold storage report was released yesterday showing pork supplies were down 1% from the previous month and 12% from last year. So there's still been a pretty good out movement here. I think in general, stocks of bellies were up 2% from last month, but down 10% from last year. And that's pretty consistent what we're seeing in the beef side of things too. Just low inventories right now, all things considered, just because it seems like everybody wants to keep on moving this high price meat out the door as fast as possible. Also, on the beef side, 6% drop from January. So it's the tightest beef supply we've had in cold storage for Feb since 2014. So I think that's something to note, that like this beef is just, we're really kind of scaling back here, and these are headwinds. There's no question about it. The record placements in February, we've got record high prices for cash right now. So there just is a lot of concern and caution, I think, going forward. Like, how long can this last? I think that's the $1 million question. We did see a bit of a drop in open commitment, at least on the cattle side of things. So I think there was a decent chunk of liquidation after that report. But all things considered, we're still waiting to see what happens here in cash. We've closed pretty weak. We're down below we were closed below the 40 days. So this was what we were talking about yesterday, that the funds are going to have to play a little bit of defense, because another leg lower is going to make this thing look pretty ugly. So I think producers just kind of have to be protected. Still, LRPs, options, there's plenty of option strategies right now that can get you a nice revenue floor. So things we're looking at this week, just seeing what the weight data says, see if the slaughter picks up at all, just to kind of give us some signs of life, and really just how cash shapes up overall.
Oh, very good. Appreciate that, Ryland. And if anybody has any questions as we head into that hog inventory report or wants to visit, you can reach out to us, info@agyield.com, or give us a call. Ryland will be more than happy to visit with you. Just coming into the open here, we got May corn down a half right now, 437 1/4. May soybeans are down 8 at 1201 1/4. May Chicago wheat's down 2 3/4 at 552 1/4. A couple administrative items here, just to keep everybody posted on this week's schedule. As we've talked about, Thursday will be the planning intentions and stocks report from the USDA. We'll also have export sales Thursday morning as well. Friday is closed in observation of Good Friday. And then the reopen of the grain markets will be Sunday night at 7 o'clock Central. So we'll go over that a couple of times here throughout the week, just so that everybody's on the same page. But as we do every day that the markets are open, we're streaming live on X, Facebook Live, and YouTube Live, 8:15 Central Time. Appreciate everybody's thoughts and comments here this morning. It was a good visit, and hope everybody has a great day, and we look forward to talking to you soon. Thanks so much.
Thanks, Dan.